We witnessed another sell-off here on Wall Street today. The S&P 500 was down 1.76%. We did see oil prices falling on some supply news. And for the most part, the technology-oriented area was once again getting hit at an inordinate rate compared to what we had been expecting out of technology kind of leading up to the month of September. So we'll talk about that. We'll see what that means for the NASDAQ. There is some interesting notes that I want to provide regarding the posture here today, some changes that are taking place. And also wanted to get into our trade application example where I placed a bullish trade on one of the most speculative stocks out there in the market right now with the hope that it's starting a little bit of a bounce move here with some news recently. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 10th, 2020. First of all, if you're new, remember to go over to YouTube, click subscribe on our channel, then make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. In addition to that, we're heavy users of Twitter. My handle is @BrandonVanZ. I would encourage you to follow me if you're not doing so already. Also, we appreciate those of you that click like and retweet on these Market Outlook related tweets. Lastly, we do have a presence on Facebook as well. Feel free to join our group at the web address embedded in the logo in front of you. All right, let's go ahead and jump into our charts here. And as you can see, I've got chart 6D pulled up here in front of us for those of you that are premium members following along at home. And for some reason, I just want to say we've got to stop meeting this way, or stop bumping into each other, whatever that phrase is. What I mean by that is this is the third straight time we've started my presentation here on the Market Outlook with this particular chart. And I was just saying, you know, the 3 times ago when we first looked at it, it had been a long time since I looked at it. Now it's been 3 straight. And so to catch you up, if you haven't been watching the prior videos, remember I typically start with this chart 6D whenever we have at least a 1% move in either the upward or the downward direction. And it just so happens that the last 3 kind of big red candles that you see here on the board are when I was doing the presentation, and David did the video on the other days. So the good news is I won't be doing the video tomorrow or on Monday, so maybe that gives a chance to the bulls to take a run at things here. All joking aside, it was another down day, and it was slightly above average down day. You can see in this case the red candle or the bar here did cross down and through that blue horizontal line. And as a reminder, you can read these labels here to try to get a sense of what that means. In this case, it means that it was a move of at least 1%. Whereas the last time I did the video on Tuesday, we had breached the orange horizontal line, which meant that we were down over 2% that day. And then when I did the video basically a week ago, last Thursday, that was this big candle here where we breached the fuchsia or pink horizontal line, and that was a 3% move. So I guess the good news is the selling seems to be not quite as aggressive and extreme as it has been. On the other hand, it was still not what you want to see if you want to be bullish in the markets right now. And remember, we're now in the month of September, and as I mentioned previously, that's typically a time when there's a little bit more nerves in the air from a stock market perspective. September and October are both somewhat noteworthy for having previous market crashes in them. So I think there's just a little bit more hesitancy amongst market participants out there. And what we saw kind of leading up to the last week or so, where we saw a lot of names just going absolutely bananas to the upside, that kind of felt a little bit like some sort of a blow-off top. Now, again, just like I mentioned in the last video, that is not my expectation that all of a sudden we're going to be back at these prior lows that we saw back in March, but that was a pretty meaningful move that we did see there a week ago. So I'm expecting us to find a bit of bounce. Could even see it as soon as early next week. But whether we have the same types of companies leading us to the upside is my big question mark right now, because it kind of feels like a lot of those work from home stocks kind of got a little bit over their skis as that miniature bubble popped. That wasn't a huge bubble or anything, but it was kind of aggressive upward price movement where people were just doing silly things like buying stocks just because they were splitting, even though that doesn't make any sense. So we got a little bit of hysteria, I guess you could say, in the market there. And so it's possible we start rotating. In fact, we talked about that a little bit the last time I did the video, where we started seeing some slippage out of the communications and technology stocks, and it's kind of giving way to some new leadership from the industrials and consumer discretionary and the materials spaces. So we're going to keep our eye on that rotation, but I do think that we still have a decent chance of still making our way back to some of those old highs. It just might be different leaders that take us in that direction. I should also point out that the VIX did rise today. The VIX was at 28 at the end of the day, but I'll make the same comment I did on Tuesday when we had a 2% down day. Today we didn't have quite a 2% down day, but still above average down day. The VIX really didn't go up that much. The VIX was pretty quiet, all things considered. If I were to pull up the VIX chart now instead of the S&P 500 here on top, you can see kind of what that looks like. The VIX was up 3% today, if you want to think of it in percentage terms. I know it's not always the best way to look at it, but at least to kind of get a sense, was that a big day, a bad day, a small day? What was it? And today was kind of a yawn from the VIX perspective, even though the market itself was down over 1%. So I think that kind of is another reason why it wouldn't be unheard of for us to take another shot at all-time highs in the stock market. It doesn't seem like there's a everybody rushing for the exits at once type of a moment. It seems like the selling has been kind of caught up in a very specific crop of investments. And as long as you're kind of avoiding those, markets have been, somewhat mundane. In fact, I was just looking at our monitor tab here on these trades that I've been taking during the video, and we're making money on all of them except for one. The only one we're losing money on right now is Gilead, and that was a sold put. It wasn't a very aggressive trade, and I'm not overly concerned about it. But otherwise, every single one of our other trades that we've put on, for my presentations at least, since early August, are making money at this point. And remember, we have a mix of both bullish and bearish trades going. We've got a bearish trade with AbbVie, with American Tower, with CVS Health, and then also with Vornado Realty. And then all the rest are bullish trades. So we have bullish trades on Google. We'll talk about the Tesla one a little bit later today. We've got a bullish trade on Bank of America, Shift 4 Payments, Gilead, and Coke. So again, I'm really happy. Remember, generally when you're kind of putting on more active trades like this, you should assume you're going to be losing a lot more trades than we have here, particularly considering, some people feel like this market behavior we've been going through lately has been wild and all over the map, and I just generally haven't seen that. I've seen it in patches with the the momentum names certainly giving back a lot of their prior gains. But if you're trading in a lot of the non-momentum stocks, the non-work from home stocks, I haven't seen really wild and erratic behavior that's out of the ordinary. So I've found this to be an environment where trading has been more than reasonable, and it's possible to make money in a market like this. And I hope you guys have found that as well. And of course, if you're not finding that to be the case, then we would encourage you to sign up for our Plus or our Premium subscriptions here at Market Scholars. And that way you can kind of get trained up by David and I every single day in our trading rooms themselves, just like the rest of our students. So I think we've done reasonably well given the circumstances. Anyway, let's go ahead and take a look kind of at our normal chart routine now. And for that, we're going to come on over here to the Market Forecast 4 grid. And real quick, while that's loading up, I did want to say thank you to those of you that clicked like for me the last time I did the video on Tuesday. 127 of you did that. Remember, my goal is to get our Twitter likes up and over 100, a nice round number there. If you like the kind of full-length 30-minute versions of these videos, go ahead and click like. If we're over 100, I'll go ahead and do that for you. If we're under 100, then I'll do kind of an abbreviated 15-minute version. So I know sometimes these videos can get a little bit lengthy, and if you're kind of feeling that strain right now, then don't click like on Twitter, and we'll have a quicker version of it the next time I do the video on Tuesday. But I do want to say thank you to those of you that go out of your way to help us along with that endeavor. Also, remember that we taught a couple classes here today. I taught my question and answer session, which is kind of like an Ask Me Anything session for my premium students. It's a 2-hour class. And then David taught his portfolio management with ETFs class. So make sure you're checking those out. If you didn't get a chance to attend live, if you're a Premium and Plus member, check out our calendar for the recordings. And then tomorrow, David teaches his very popular technical analysis class. And of course, we'll all remember that it's September 11th tomorrow, so a bit of a somber day as we remember some of the sacrifices and some of the difficulties our country went through that terrible day back in 2001. But David will be with our students at 1 p.m. Eastern Time, helping them along with technical analysis. All right, back to the charts here. You can see S&P 500 down 1.76% today. Dow Jones down 1.45% today. NASDAQ Composite down 1.99% today, so let's call it 2% there. And then the Russell 2000 was down 1.23% today. So it was, once again, the NASDAQ that was actually the leader, the laggard, or the biggest loser, however you want to say that. And that is saying something, because for most of the summer, we coasted in the NASDAQ. The NASDAQ was the place for the hot trade. And that might be changing a little bit here. Now, we did have a couple of stocks after hours that are important to the NASDAQ that were reporting their earnings. So let's check in on them real quick, because I'm curious myself. Peloton was one. And Peloton ended the normal session at $87.75. It currently has a bid of $93.23 after hours. So that's looking really good right out of the gate. That stock is up about $6 per share after hours. Another one was Chewy. And looks like Chewy has kind of been all over the map, both down and up after hours. At this exact moment in time, it looks like it's down maybe about $1 per share after hours. So pretty moderate, reaction to that particular stock that's done so well in this COVID environment. And then Oracle was another one that reported their earnings. And that one looks like it's doing quite well as well. So ended the day at 57.33 and currently has a bid of 59.10. So at least in 2 out of those 3 cases, we do have some upside action. Hopefully that supports the NASDAQ tomorrow, since all 3 of those are NASDAQ-oriented companies. But as you can see, it was an important day for the NASDAQ, not just recognizing that it was the laggard once again, down the most today, but you can see a color change on the chart itself. Notice that the color yesterday of the background was light pink. The color today is that dark pink color, and that signifies that we now have what's known as a strongly bearish posture on the NASDAQ. And you can see here the reason for that is the green line is now down below the 50th percentile. So remember, once the green line falls out of the upper reversal zone, it is considered a weakly bearish posture. If it continues to travel lower, which this one has, and it eventually crosses the 50th percentile of that underlying indicator, then it becomes what we consider strongly bearish from a posture perspective. And you can see the number itself is at 45, so it has firmly crossed below 50 to the downside. So that's the first time for the NASDAQ in 3 months that we've had a strongly bearish posture. As you can see here on the chart, we haven't had any dark pink shadings over here to the left-hand side. If I change kind of the time format and go to, let's say, 6 months instead, there we can see that the last time we had strongly bearish posture would have been all the way back here at the beginning of April. Can you imagine? We've had a heck of a run here for the NASDAQ over that time period. So anyway, today was an important day for those of you keeping track of the posture there at home. And same thing can be said for the S&P 500. Notice how the background color changed from light pink to dark pink as that green line fell below the 50th percentile. It's doing a little bit better than the NASDAQ. It's only at 48 as opposed to the NASDAQ, which was at 45. But nonetheless, still that strongly bearish posture. And then the same thing happened over here on the Russell 2000. and it is down at 45, kind of sharing the same level as the NASDAQ. Now, a couple of days ago, I mentioned that it was my guess that if one of these goes to a strongly bearish posture first, it would be the Russell 2000. I was kind of right, I suppose, because yes, today was the day that it went, but it shared that notoriety with the S&P 500 and the NASDAQ. So they played a little bit of catch up there in a hurry. Now you'll notice that the Dow Jones does not have that dark pink shaded background yet. And the reason for that is the intermediate line for the Dow Jones is at 58 and falling. So it hasn't fallen below the 50th percentile yet. So right now, if you're going to make the claim that there's a quote unquote leader in this market, I guess you would say it's the Dow Jones. Not necessarily because they're lighting the world on fire, but mostly because they haven't fallen quite as aggressively as some of those other areas. You can even see it from the placement of the candle on the chart versus the 30-day moving average. Notice how far below the moving average the Russell 2000 is. Notice how far it is for the NASDAQ Composite and for the S&P 500. The Dow Jones is not down below as much as the other three, and therefore that's another reason to say that there is a bit more embedded strength in the Dow right now than some of those other areas. I'm not here to say it looks good. We still don't like the look of that light pink background color combined with the fact that it closed below its moving average for the second time in 3 days, but at least it's still clinging to the line enough where it wouldn't be all that surprising if it could gather itself at around this level and bounce up and off of that rising moving average. Remember, the Dow is kind of known as the big lumbering giants of the world, your Coca-Colas, which we have a trade on in this particular paper portfolio, and your Procter & Gamble's. Those types of companies are generally going to be able to withstand market pressures a little bit better than some of the momentum-oriented names. And remember, it probably helps that Apple is no longer as influential in the Dow Jones Industrial Average as it was just a couple of weeks ago. Remember that since Apple went through their split, their share price is a lot smaller today than it was just 3 weeks ago, and therefore with the Dow Jones Industrial Average being kind of a peculiar index in that it is a price-weighted index, Apple is much less meaningful in the Dow today than it was just a few weeks ago. And that's important because as we look at Apple here, you can see it was down 3.26% today. So it was a pretty aggressive selling there once again in Apple. And remember, Apple is going to have the most influence in the S&P 500 and also the NASDAQ Composite because those are market cap weighted, and Apple is still the largest company from a market cap perspective. So that could explain a little bit more of the Dow Jones's buoyancy compared to the others as well. All right, let's go ahead and take a look here now at our 3 green arrows chart. And I would assume that there are probably 3 red arrows still, but let's just verify that. So this would be chart 4D for those of you following along at home. All right, and that is indeed the case. We have 3 red arrows on all 4 of our charts. And remember, the 3 red arrow signal is effectively just looking at the 30-day moving average, the MACD histogram, and the stochastic. And the most recent arrow in each of those 3 indicators is how we determine whether we have 3 green arrows, 3 red arrows, or a mix of green and red arrows. And right now, we have 3 red arrows across the board. And our ThinkScript programming makes that easy for us to see visually because the background color is red in the case of 3 red arrows. And that is the case with all 4 of our charts right now. So in the case of the S&P 500, and the Dow Jones, that's new information because yesterday both of those indices popped back above the moving average, in which case they got their green arrows yesterday, but that was awfully fleeting because 1 day later they're right back to red arrows. So keep in mind there can be a little bit of a tug of war that takes place there at that 30-day moving average, and if we have a good strong session tomorrow, we will see those green arrows emerge again on those moving averages there. So let's keep our eye on that situation. But for the most part, the good news is that the moving averages are still trending higher. Remember, if they weren't, the moving average tips would be red. And right now, in all 4 of the charts cases, they are yellow. There's a little bit of caution or hesitation there where we have price below a moving average, but the moving average itself is still higher. If price is ever below a falling moving average, those tips will turn red, which is a little bit more of a bearish indication. So right now the point is, the bulls have been hit. They've taken some gut punches here lately, but they're not down and out quite yet. There's still an ability to catch their breath and make a run of things here. Let's go ahead and take a look at the 1040 crossover method now, and that will be chart 4C. And as you can see, not a whole lot to report here. Remember, this is the least sensitive of the charts that we look at during this presentation because these are weekly candle charts. And in each of these 4 cases, they go back 3 years in length. So it's kind of a longer term investor's view of things as opposed to a short-term orientation. And you can see here that we have bullish crossovers on all 4 of our charts. So the background colors of the charts will turn green when we have that orange moving average, which represents the 10-week moving average, go up and through the less sensitive 40-week moving average, which is represented by that blue line. And so in all 4 of our charts cases, we do have bullish crossovers. However, there is one thing I should report for you, which is you'll see a tiny little red arrow there on the Russell 2000. In fact, let me see if I can right-click and maximize that cell so we can see it in one screen there. Just to the left of my mouse, there's a little red arrow. That does not signify that we have a crossover, a death cross or anything along those lines. What it does mean is that we are starting to push upon that moving average itself. So it's kind of it's a pre-warning, I guess you could say, that if there is going to be a negative crossover, one thing that we could infer from this information is that it's likely to be the Russell 2000 that gives us the bearish death cross first before the rest of them, because the rest of them are still trading firmly above their 10-week moving averages, whereas it's not so obvious there for the Russell 2000. So we'll keep our eye on that, and if we do get a death cross one of these up and coming weeks, I'm sure David and I will do our best to notify you of that. Let's get into some 12 grid analysis now. Let's go on over here to chart 5A, and this will be our asset class 12 grid. I wanted to point out oil because that was one of the big stories here today. I remember we talked about this on Tuesday as well, where we had that oil chart really fall out of bed, and it caught a little bit of a bounce yesterday, but then gave it all right back today. We were down over 2% on a barrel of oil here today, and that's not a pretty looking chart there. This is a chart that broke lots of levels of support in just the last week or so's worth of trading, and now you can see that the technical damage has been severe enough, it's actually pulling that 30-day moving average lower, right? And the 30-day moving average is always going to be a lagging indicator, so it usually takes a pretty aggressive move to go from green to red that quickly. And what we did witness in the last week was indeed a pretty aggressive move to the downside for oil. So we'll talk about the sectors here in just a little bit, but no surprise that energy stocks have been getting beat up here recently. Now, along the lines of the conversation of commodities, I'm a little bit more pleased with what's going on with gold. A couple days ago I said, hey, we're kind of at this make or break moment here on gold. So let me right click and maximize that cell. This was 2 days ago right here on this candle. And we were basically sitting right at the low of that candle and sitting right at the low of those 2 candles over there. Had a little bit of a gap fill situation back here as well in around that zone. So this was a very important candle that we were at 2 days ago. And I'm happy to report so far it's held up. Now, I don't think the coast is clear here because you can see today was a kind of a nasty reversal type of a candle here. Gold, or at least in this case GLD, which tracks gold, was down 0.32%. And that's not a terrible day by any means, but it was a disappointing day because much like the stock market itself, things actually look promising at the beginning of the day. Remember, the stock market was up nicely today. Gold was up nicely today. But as soon as it touched that downward trending 30-day moving average, it rejected it and closed near the lows of the session. That's what that filled in red candle means there. Remember, sometimes you get these red candles here that are not filled in. They're open candles. That usually means you kind of had like a gap down to start the session and you closed a bit higher than where you started the day. The opposite can also be true, where you might gap up to start the day and close near the lows of the session. Those are a little bit more ominous. And so we did have one of those candles here today, and it happened right coincidentally at that downward trending 30-day moving average. It's not a great sign. So we're kind of playing this tug of war here, trying to determine, is this horizontal level down here that we touched 2 days ago going to, is that level of support going to hold, or are we going to bounce down and away from that now downward trending 30-day moving average, in which case we might very well look back at this gold chart and say, yes, we can clearly see that we have lower highs across the board. We would have basically 1, 2, 3, 4 lower highs if this was an important kind of high day that we're dealing with today. So we won't find that out until the future unfolds in front of us. But there's room in between here where it can gather itself, and at least it looks better than oil, but it still doesn't look great generally speaking. You do have that green line trending closer to the lower reversal zone right now. We do have a strongly bearish posture on gold. In terms of any areas of strength, we shouldn't be surprised, I guess, to learn that the US dollar, as you can see, was up today. It was up 0.2%. We are now trading above that moving average. The moving average is still trending lower. That's why the moving average is yellow in this case, but it is quite flat, and that is important to recognize, because if the US dollar does continue to have a few more up days there, you might start to see that moving average curl higher as well. You can see it's kind of just still meandering just a touch lower right there with that yellow line. But this is the type of move here. This is a pretty decent sized candle today, where if we get another one of those tomorrow and we start clearing above this resistance from over here at the end of August, I'm going to assume that the UUP is actually going to start showing a green moving average soon enough. We have a strongly bullish posture on UUP, and it's been a long time since we've been able to say that. You can see down below what I mean. This green line is now up and over the 50th percentile. It's at 53 and rising right now. So that signifies a strongly bullish intermediate posture. And you can see this is the first time in 3 months we've been above the 50th percentile. The highest we got before that was over here first couple days of July. So this is a pretty important move we're making off of the lows here on the US dollar after kind of putting in a whole bunch of these oversold cluster signals. It now starts to seem like, yeah, maybe there was something to that. Maybe the US dollar will find a bit of strength here. So we're going to keep our eye on that. And the only other one that had a bullish chart is over here with TNX. That's your 10-year US Treasury yield. Not a really aggressive day there in either direction, but it is noteworthy that it's holding above that rising moving average in that particular case. But you actually saw bonds up today on a sell-off day for the market. So they're trying to figure out where they want to put interest rates at this moment. In terms of some of the stock charts up above, I should point out EFA was down 1.17% today. That's your developed foreign stocks. And EEM, the emerging market stocks, were down 1.6% today. Both of them are noteworthy in that the moving averages are red. Notice that change there. So we're starting to see some wear and tear on those foreign markets to the point where the moving averages are starting to slump over. It's generally not a great sign there. So we want to keep our eye on that. And obviously, if you're looking for bearish trade setups, you can look beyond the United States shores for opportunities on occasion as well. And in the case of EEM, we actually have a strongly bearish posture in addition to the red 30-day moving average. All right, let's go ahead and talk about our sectors very briefly here. Our sectors were a clean sweep to the downside once again, just like we witnessed on Tuesday. And just like on Tuesday, the two worst sectors were energy and technology. Energy was down 3.6% today, and technology was down 2.2% today. Both of them, you can see here with the dark pink backgrounds, are showing us that we have strongly bearish postures. Now, obviously, one of the charts looks a heck of a lot better than the other. The technology chart is still doing quite well over the last 3 months. It's up 9%, whereas XLE energy is down 24% in 3 months. Ouch. That's going to leave a mark. So if you're hoping that we get some sort of a recovery in the general stock market, I think you're probably better off still hunting in the technology area as opposed to playing the bottom fishing game there in energy land, where it's just been one disappointment after another. One thing I did want to point out before we get into our trade application here today as well is that discretionary was down today, like all the rest of the sectors. It was down 1.4%. So it was a relative outperformer today versus the market itself, which was down 1.7%. And the other thing I wanted to point out is that discretionary is still firmly above its rising 30-day moving average. So if I right-click and maximize that, you can see, yeah, we struggled today, and that's a bearish engulfing candle, at least from the body's perspective. But we're still above that rising moving average, right? We have not closed below that, whereas so many other sectors have. So if there is some relative strength out there, discretionary is one of those sectors that's providing it. And that kind of ties me into my trade application for today. And it's a stock that we actually talked about in 2 of my question and answer sessions that I answered today during my class. So it's a very controversial stock, without a doubt, and that is Tesla. And with Tesla, it's been kind of interesting because, of course, they've been in the news for, the rug pull that's taken place over the last couple of weeks where, things were flying high. This thing was up over 500 on a split adjusted basis, and then whoop, all the way down there to $330 just a couple of days ago. In fact, yesterday, was it yesterday or the day before, I noticed in the after hours session it had gotten all the way down to, I think it was 308 in after hours session. So things were looking really hairy there for a while. The last 2 days we've had a nice little recovery. And what I like about it is it's recovering right at that upward trending 30-day moving average. Now be aware, Tesla is not for the faint of heart. It is not a stock that I would consider cheap by any stretch of the imagination. It is wildly overvalued in my own mind. So this is not something where I'm saying, okay, I love Tesla, I'm going to go out and I'm going to buy a whole bunch of it and just cross my fingers and hope for the best. So what I'm doing is I'm recognizing that, yes, this is a dangerous stock considering its valuation, but it's also a stock that's showing us some stability on its chart versus a lot of other companies that are out there. You can see this stock is still easily beating the S&P 500, so it's a relative outperformer in the last 3 months. It's actually up 90% still, despite that huge haircut that it took. It's up 90% in the last 3 months. You can see that it is stabilized around that upward trending 30-day moving average. It had kind of a nice what you might be able to get away with calling a hammer candle yesterday, which is at a support level, and you saw a little bit of a follow through today. Now, admittedly, this is not the most beautiful chart today, or candle today, I should say. Right? We sold off from the highs of the session, but an important thing that did take place today is we now have a bullish near-term posture. That's why that background color on this chart 3A has turned from pink yesterday to blue today. We now have kind of a green light from a swing trading perspective to take a bullish trade on this if we so desire. So then the question is, what type of a bullish trade do you want to take? You guys know that a lot of the trades that I do where I'm a little bit more neutral, I'm neutral to bullish, I oftentimes sell puts. I sell naked puts or cash covered puts, however you want to say that. I definitely don't want to do that with Tesla, at least for me. It's not for the faint of heart. Some of you might very well do that, and God bless you. But for me, I would be too paranoid that the stock could collapse like $300 in a few weeks or something like that. So I don't want to set myself up for that type of a possibility. So instead, what I'm going to be doing is selling a bull put spread. So part of that is indeed selling the put, just like I would when I would sell a naked put. But in addition to that, I'm combining it with a long put, so I'm structuring it as a spread, and that long put serves to act as kind of a built-in hedge in case things go really haywire to the downside with Tesla. And so what I ended up doing, and remember, I already got this trade placed. It was placed here about 25 minutes before the bell, and I sent that out to all of our premium members via Telegram app. So remember, that is one of the benefits you have if you sign up for a premium subscription with Market Scholars. We'll send you trade alerts whenever we place our trades for our other classes and the Market Outlook trades as well. So that way you guys can examine them before the bell, as opposed to everybody else watching the free YouTube video that has to examine it after the bell and then has to put their order in the following day. So anyway, what I did was I sold the 282 put in the month of October, and I bought the 280 put in the month of October. For the sold put, I collected a credit of $11.55. For the bought put, I had to send out a debit of $11.05. And so that made me a credit of 50 cents on a $2 wide spread there. So I have about a 33% return on risk with this particular trade. For those of you that are newer to these bull put spreads, effectively what I'm trying to do is make sure that Tesla stays above 282. And I get a credit up front for placing that, wager, so to speak. I should be careful with that terminology. We've got Thursday night football tonight, and there might be some betting and some actual wagering going on out there. But in this case, I'm kind of making the bet that Tesla is going to stay above 282 until the October expiration. And as long as it does, I get to keep that $50 that I took into my account. If it doesn't, and Tesla goes haywire to the downside, and let's say it ends up at $250, then that bought put helps protect me anything where it goes less than $280. Now, I'm still going to lose money in that trade. I'm going to lose $1.50, the difference between 50 cents and the $2 between the strikes. But I won't lose more than that. So it is a defined risk trade, and that's the point that I wanted to stress as far as why I didn't sell a put on Tesla like I sold puts on Bank of America and Shift 4 Payments and Gilead and Coca-Cola. Remember, those were all sold put trades. I did not want to be so aggressive with a stock like Tesla, and this allows me to kind of embed a hedge into my trade itself just in case the stock really, really collapses. So on this chart here, you can now see where my blue line is, and that blue line is my break even on this trade. Remember, if my sold put is the 282 and I subtract 50 cents of the credit out of it, then my break even is 281.50, and that's where this blue line is here. You can see that matches up pretty nicely with where you had this mini kind of resistance area here for a few days back in the first week of July. It went up after that, came back down, retested it right there. It retested it again right there, and those levels seem to hold. So there does seem to be some interest in buying Tesla at around $280 or thereabouts. And so I'm kind of making the bet that if it does roll over from here and goes down to that blue line, that those buyers will step in once again and hopefully push up and off of that to help protect my trade. Okay, so that's our trade application here for tonight. Thanks again for checking out this video. Remember, if you got value out of it, if you learned anything from it, or just enjoy having a daily update as to what's going on in the stock market, make sure you click like for us over there on Twitter. I'll have it pinned to the top of my timeline. Remember, you can also click like right within the Twitter kind of widget that is directly below the video that you're watching on our website as well. If more than 100 of you click like, I'll plan on doing another full-length version of this video on Tuesday. If less than 100 click like, then I'll just do the 15-minute version. So I'll let you decide what direction you want to take it with that outcome. With that, I want to wish you all the best of success with your trades and your investments. Enjoy the game tonight for those of you that are Chiefs or Texans fans. And David will be back with you tomorrow, and I'll see you next Tuesday. Take care, everybody. Bye-bye.